Curzio here, and I wanted to talk to you real quick about one of the biggest risks in the marketplace, a risk that I feel like not too many people are talking about, because we hear inflation is a risk, people are raising prices. I just came back from Orlando. Their prices are being raised, but everybody has more money than they ever had because we're giving checks to people all at the same time. So people say inflation is a major risk, but we could see that coming. And we could adjust, and the Fed could adjust to that. We see valuations are very stretched. Again, something that we see, and yes, we could see a pullback. We've seen that with the NASDAQ, and it is rebounding today. The biggest risk by far, which is going to lead to the next market crash, is leverage. Leverage is almost a cause for every crash. And what we saw in Archegos is a company that was heavily leveraged, 20, 30 to 1. And I feel like what's being mentioned on TV is more about how Goldman Sachs and Morgan Stanley were able to talk to them and get out of their positions. And by the way, they probably shorted the stock knowing that they're going to trigger a margin call for these guys, which crashed a lot of stocks, Discovery and a whole bunch of other ones, and Viacom. So you're hearing that story about the stocks crashing, Goldman Sachs, and then who got holding the bag was Credit Suisse and Nomura. And there's a much bigger part to this story that nobody knew how much this company was leveraged. They had off-sheet transactions, off-balance sheet, offshore subsidiaries. So nobody knew how leveraged these guys were. And it caught the market by surprise. And some people knew, some people didn't. Again, that's a great story. But what does that say for the rest of the market? Because we have a Fed that's promoting this, right? They're promoting this by low interest rates. Take on as much risk as you can. We have hedge funds out there that manage other people's money. So take as much risk, leverage as much as you can. And if you make money, it's an absolute fortune. If not, you're losing other people's money. What we're seeing right now in this marketplace is extremely dangerous. It reminds me of the credit crisis. I want to bring up something really quick to you. So when we look here, I'm going to share my screen, which I like to do a lot. This is during the credit crisis. So when we look at the credit crisis and the market really crashed right here, look when the market actually crashed. So if you can see this line right here, we're looking at 2007, right? A couple months 2007, but even here, not too much, right? Open at 1500, the S&P 500. This is since October 2007, before we hit the 666 low, right here on the bottom. But the market really didn't crash here, but the writing was on the wall. And when we see, this is something else I'm going to bring up, I want to show you some of the news, right? So the writing's on the wall for the credit crisis. What was happening? February 2007. Remember, I just showed you the market was doing okay. It was down a little bit. Freddie Mac announced that no longer could buy risky subprime mortgages. New Century Financial went bankrupt. Bear Stearns suspends redemptions and leverage mortgage-related products, right? You're looking at credit agencies started downgrading hundreds of these things, which is kind of ironic because they're mostly the cause. They just, wanted their fees and whatever to put AAA ratings on everything. German bank needed to be rescued. Bear Stearns liquidates 2 hedge funds that invested in mortgage-backed securities. Look at the dates on these, right? So all this happened. The writing was on the wall. Only a few people were paying attention. Right now, the writing's on the wall. We're seeing massive, massive leverage in the marketplace. It's not being mentioned anyplace. We just saw Melvin Capital get crushed by, 2-3 million people on Reddit because they were able to see that position. Again, that's the hedge fund's fault because they had options and you could see it. Sometimes you can't see the short positions most of the time. These guys had options. But for you to really think that this is limited to these 2 funds is naive and absolutely crazy. So guys, to protect yourself and how to make money off of this, look, the market can go up a lot higher from here. It could take 6 months. It could take a year. Just like you saw, a lot of this market started breaking down in 2007. It took 6 months, 9 months for everything to really crash. Again, the writing's on the wall here with all the leverage in the marketplace. And all this stuff works until it doesn't. And what do I mean by that? Is the whole entire market's going higher and higher and higher and higher and higher, and it's all fun. All asset prices are being raised across the board, collectibles, NFTs, home prices, everything, right? Commodities, everything's going higher, so everybody's happy. But when this thing really pulls back, especially look at Bitcoin and the amount of leverage that people could, owning Bitcoin at 50, 75 to 1, when these assets start coming down, and they will, this is the market, things go up and down, they don't go straight up, you're going to see a lot more names, a lot more of this forced liquidation. And what you want to do is protect yourself. Protect yourself very easily by buying puts. That's the easiest way. On the S&P 500, the Russell 2000, leverage 3% of your portfolio. And if you're wrong and the market goes up, it's going to make up the difference of the 3%. But if you're right, that 3% position could turn into 15, 20% of your overall portfolio, especially if the market really crashes. What I'm seeing right now are cracks in the foundation. It's going to take a while to develop. It's not there yet, but there's tons of hedge funds that are over leveraged. Again, the Fed is promoting all this. You can't just throw trillions of dollars and tens of trillions of dollars at everything, keep interest rates low and expect everything to be perfect. If it was that easy, they keep interest rates low forever. And announce another 20 trillion in stimulus. It's not that easy. Right now it's working until it doesn't work. So be very careful. Buying puts is very, very simple. We have a newsletter, Money Flow Trader, that actually does that. Question and comments, be sure to send them to frankcurzioresearch.com. Be sure to like our Curzio Research YouTube page. And as always, I'll report back to you guys soon. Take care.